The silence before the fracture. Every currency collapse begins with a whisper. Not a crash, not a headline, a whisper. A central bank speaks carefully, a trade route shifts, a buyer hesitates, and somewhere in a system built on trust, something fundamental stops working. This is that moment. On February 18th, 2025, the European Central Bank made an announcement that most financial media described as routine policy adjustment. They didn't use dramatic language. They didn't declare emergency measures. They simply stated that certain sovereign bond purchase windows would be temporarily modified to reflect evolving market conditions. The statement was 17 words long. Markets barely moved, but 3 days later, Germany's 10-year bond yield spiked 43 basis points in a single session, the sharpest intraday move since the sovereign debt crisis of 2011. Then it happened again and again. What appeared to be a technical adjustment was revealing something far deeper. The mechanism that has stabilized European debt markets for over a decade was no longer functioning silently. It was now functioning visibly. And in monetary systems, visibility is vulnerability. This is not new. In 1976, the Bank of England faced a similar moment. For 18 months, the British government had been managing sterling's decline through what officials called orderly adjustment, a phrase designed to sound controlled, deliberate, intentional. But by September, the market began testing whether that control was real. Gilt yields rose, currency reserves drained. The IMF was quietly approached. The system didn't collapse that week. It simply became visible. And once visible, it became fragile. The pound lost 30% of its value within 6 months. Not because Britain's economy had suddenly failed, but because the illusion of control had been tested and found wanting. The European Central Bank's bond purchase program was never designed to be permanent. It was introduced in 2015 as a crisis measure, temporary, targeted, and extraordinary, a tool to prevent sovereign debt markets from fragmenting during extreme stress. But temporary measures, when sustained long enough, become structural. By 2025, the ECB held over $5 trillion in Eurozone government bonds, roughly 40% of all outstanding sovereign debt. That's not a safety net. That's the floor. And when floors become visible, markets begin testing whether they'll hold. Germany's bond market is supposed to be Europe's anchor. The bund yield is the baseline, the risk-free rate against which all other Eurozone debt is measured. When Italian bonds yield 4% and German bonds yield 2%, that spread reflects perceived risk. But it also reflects something else, the assumption that Germany will always remain liquid, stable, and buyable. That assumption is now being questioned, not because Germany's finances have deteriorated, but because the mechanism that kept bund yields suppressed, ECB purchases, is no longer invisible. And once investors see the support structure, they begin pricing in what happens if it's removed. This dynamic has appeared before. In 1931, Austria's Creditanstalt, the largest bank in Central Europe, collapsed not because of sudden losses, but because depositors began questioning whether liquidity support from the Austrian National Bank was sustainable. The bank had been quietly supporting Creditanstalt for months, but when that support became public knowledge, it triggered the opposite of confidence. Depositors withdrew, counterparties pulled credit. The crisis spread to Germany, then Britain, then across the Atlantic. Not because the initial problem was catastrophic, but because the visibility of intervention revealed systemic fragility. The ECB's February statement didn't announce a policy reversal. It announced recalibration. But recalibration is what central banks say when they can no longer sustain previous commitments without acknowledging cost. Here's what makes this moment structurally significant. And cost, in monetary systems, is always denominated in credibility. For the past 15 years, European sovereign debt markets have operated on a single unspoken assumption, that the ECB would always be the buyer of last resort. That assumption allowed weaker Eurozone economies, Italy, Spain, Portugal, to borrow at historically low rates despite elevated debt to GDP ratios. It allowed Germany to finance industrial subsidies and energy transitions without yield pressure. It allowed the Eurozone to delay structural reforms because financing costs remained artificially suppressed. But artificial suppression is only sustainable when it remains invisible. The moment markets begin pricing an ECB withdrawal, even partial, even gradual, is the moment spreads widen, and when spreads widen, debt servicing costs rise. And when debt servicing costs rise, fiscal space contracts. And when fiscal space contracts, political pressure builds. This is not theory. This is the documented sequence of every sovereign debt crisis in modern history. Between 2010 and 2012, Greece, Ireland, and Portugal entered bailout programs not because their debt levels were historically unprecedented, but because markets stopped believing those debts could be refinanced at sustainable rates. Yields spiked, liquidity evaporated, contagion spread. The crisis was only contained when the ECB's Mario Draghi declared in July 2012 that the bank would do whatever it takes to preserve the euro. That phrase, 3 words, stabilized markets for over a decade, not because it represented new policy, but because it represented unlimited commitment. What happens when commitment becomes visibly limited? What happens when whatever it takes becomes within adjusted parameters? Markets begin testing boundaries, and once testing begins, it doesn't stop until something breaks, or until intervention becomes so large that it itself becomes the story. On February 21st, Italian bond yields rose above 4.2%, the highest level since 2023. That spread over German bonds widened to 190 basis points. Still manageable, still within historical norms. But the direction of movement is what matters. Because in sovereign debt markets, momentum is contagion. Italy's debt to GDP ratio sits at 137%. Its fiscal deficit remains above 3% of GDP. Its economy has grown at an average of 0.4% annually over the past 15 years. None of this is new information, but new information isn't what moves markets. Repricing does, and repricing happens when the structure supporting asset values becomes visible. This is how confidence erodes, not through panic, through recalibration, through investors quietly adjusting models, through banks subtly reducing exposure, through pension funds rebalancing portfolios. Each move is small, rational, justifiable, but aggregated, they represent a shift in perceived risk. And perceived risk in financial systems becomes real risk, because behavior follows perception. The ECB now faces a problem that central banks always face when intervention becomes structural. Any reduction in support looks like abandonment. Any continuation of support looks like dependency. There is no neutral path. History suggests what comes next, not because the future repeats the past exactly, but because the incentives facing policymakers, investors, and sovereigns follow recognizable patterns. When central banks reduce bond purchases, yields rise. When yields rise, fiscal pressure builds. When fiscal pressure builds, political fragmentation follows. And when political fragmentation follows, markets test whether monetary union can survive political divergence. This is the test that broke the gold standard in 1931, the test that broke Bretton Woods in 1971, the test that nearly broke the euro in 2012. Each time the structure survived, but only through intervention so large it redefined the system itself. Because in sovereign debt markets, momentum is contagion. Italy's debt to GDP ratio sits at 137%. Its fiscal deficit remains above 3% of GDP. Its economy has grown at an average of 0.4% annually over the past 15 years. None of this is new information, but new information isn't what moves markets. Repricing does. And repricing happens when the structure supporting asset values becomes visible. This is how confidence erodes, not through panic, through recalibration, through investors quietly adjusting models, through banks subtly reducing exposure, through pension funds rebalancing portfolios. Each move is small, rational, justifiable. But aggregated, they represent a shift in perceived risk. And perceived risk in financial systems becomes real risk because behavior follows perception. The ECB now faces a problem that central banks always face when intervention becomes structural. Any reduction in support looks like abandonment. Any continuation of support looks like dependency. There is no neutral path. History suggests what comes next. Not because the future repeats the past exactly, but because the incentives facing policymakers, investors, and sovereigns follow recognizable patterns. When central banks reduce bond purchases, yields rise. When yields rise, fiscal pressure builds. When fiscal pressure builds, political fragmentation follows. And when political fragmentation follows, markets test whether monetary union can survive political divergence. This is the test that broke the gold standard in 1931, the test that broke Bretton Woods in 1971, the test that nearly broke the euro in 2012. Each time the structure survived, but only through intervention so large it redefined the system itself. The question is not whether the ECB will intervene again. The question is whether intervention still works when markets expect it. Because expectation is the mechanism through which monetary policy functions. And when expectation becomes dependency, policy loses effectiveness. February's bond market moves were small, manageable, within historical ranges. But the pattern is what matters. Because systems don't break when stress is unprecedented. They break when stress becomes sustained, and margins are thin. Every empire that issued currency faced this moment. Rome debased the denarius when military costs exceeded revenue. Britain abandoned gold when war debt became unsustainable. The United States closed the gold window when foreign claims exceeded reserves. Each time, the decision was presented as temporary. Each time, it became permanent. Each time, the system that followed was weaker than the one that preceded it. The Eurozone is not collapsing, but it is entering a phase where support mechanisms are becoming visible. And visibility in monetary systems is the beginning of fragility, not the end, the beginning. What makes this moment significant is timing. The ECB's recalibration comes as Europe faces compounding pressures, temporarily masked by monetary accommodation, energy dependence, demographic decline, industrial erosion, geopolitical realignment. Each force was manageable when financing costs were suppressed. But when costs rise, policy options narrow. And when options narrow, political fractures widen. Consider Germany's position. For 2 decades, Germany benefited from the euro more than any other member state. A structurally undervalued currency for its export-driven economy, access to peripheral European markets without exchange rate risk, declining borrowing costs as capital fled weaker Eurozone economies toward German bunds. But that equilibrium depended on one critical assumption, that Germany would never have to choose between fiscal discipline and Eurozone stability. That assumption is now being tested. Germany's industrial model, export-led manufacturing on cheap Russian energy, is broken. Energy costs tripled since 2021. Key industries lose competitiveness to Asian producers. Political consensus on fiscal restraint fractures, and as Germany needs public investment, yields rise. This is the dynamic that breaks currency unions, not external shocks, internal contradictions. Forces that held the system together become forces that pull it apart. Spain and Italy need continued ECB support to refinance debt at sustainable rates. Germany needs fiscal space to restructure its industrial base. France needs both. The ECB cannot simultaneously provide unlimited bond market support and maintain credibility as an inflation-fighting institution. Something has to give. History tells us what that something is. Not the currency union itself, not immediately, but the terms of that union, the implicit bargain that held it together. In 1931, the gold standard didn't formally end. Countries simply suspended convertibility. Temporarily, they said. In 1971, the Bretton Woods system didn't collapse. The United States simply closed the gold window. Temporarily, they said. In 2012, the Eurozone didn't fracture. The ECB simply began unlimited bond purchases. Temporarily, they said. Each time, temporary became permanent. Each time, the system that emerged was fundamentally different from the one that preceded it. The ECB's February announcement may seem minor, a technical adjustment, a recalibration of purchase windows. But technical adjustments in monetary systems under stress are never just technical. They are reveals, moments when the structure supporting the system becomes visible. And visibility, once achieved, cannot be reversed. Markets are now pricing in a Eurozone where ECB support is conditional rather than unconditional, where bond purchases are finite rather than infinite, where monetary policy operates within constraints rather than beyond them. This repricing is rational. It is also destabilizing, because the Eurozone was never designed to function without unconditional support. It was designed to prevent the need for it, but prevention failed. And now the question is whether the system can transition from dependence to independence without fracturing. History suggests the answer, not through prediction, through pattern recognition. Monetary unions under fiscal stress face a recurring choice. Integrate further, pooling debt, centralizing fiscal authority, accepting political union, or fragment, allowing divergence, accepting market discipline, risking systemic breakdown. The middle path, monetary union without fiscal union, only works when central bank intervention masks the contradiction. And when intervention becomes visible, the contradiction resurfaces. The Eurozone has faced this choice before. In 2012, it chose intervention. The question now is whether intervention remains available, or whether the cost of intervention, in credibility, in inflation expectations, in political legitimacy, has become too high. The answer will not come through announcement. It will come through market behavior, through yield curves, through capital flows, through the quiet recalibration of risk, and that recalibration has already begun. The Eurozone's next phase will not be announced. It will emerge through the accumulation of small decisions, a bond auction that clears at higher yields, a budget negotiation that fails, a political coalition that fractures over fiscal transfers. Each event will be explained as isolated, as manageable, as within historical norms. But aggregated, they represent something larger, a system transitioning from implicit stability to explicit fragility, from unconditional support to conditional intervention, from monetary union to something else, not yet defined. This is the pattern. This is how systems change, not through revolution, through evolution under stress, through slow recognition that what was assumed permanent was always conditional. And the conditions have shifted. Empires don't collapse overnight. They unravel quietly through small adjustments that seem rational in isolation, until adjustments accumulate, until structure becomes visible, until confidence becomes conditional, and then the system doesn't break. It simply stops working the way it used to. History doesn't repeat, but the sequence does, and the wider Eurozone sequence has already begun. The real question is what will follow next, and when that happens, the architecture of European integration will